The closing bell echoes across Wall Street, not as a sound, but as a signal. Screens flicker from green to neutral. Algorithms pause for a fraction of a second. Traders lean back in their chairs. Outside, winter light reflects off glass towers that house the most powerful financial institutions on Earth. On the surface, it looks like another routine market close. But beneath the calm, something historic is forming. 7 companies, just 7, now carry nearly 1/3 of the entire U.S. stock market on their shoulders. Their combined market value exceeds $14 trillion, more than the GDP of most nations, more than the combined value of hundreds of other publicly traded companies that quietly employ millions of people. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. They are called the Magnificent Seven, the crown jewels of modern capitalism, the companies everyone owns, often without realizing it. And that is the paradox. Never before have so few companies mattered so much. Never before has so much capital been tied to such narrow assumptions. And never before has the market felt so safe while standing on such unstable ground. This story is not about bad companies. It is about great ones. These firms build the phones we carry, the software we rely on, the clouds that store our lives, the chips that power artificial intelligence, the platforms that shape global culture. They are innovative, profitable, and dominant. Yet history has a rule it enforces without exception. When expectations outrun reality, price, not quality, takes the punishment. Tonight, the numbers tell a quiet but dangerous truth. These 7 companies trade at valuation levels that assume extraordinary growth far into the future. On average, investors are paying more than 40 times earnings, nearly double what history has allowed even for market leaders at their peak. To justify those prices, profits must grow at a pace rarely sustained by any business, at any time, in any era. But growth is slowing, not collapsing, not disappearing, just slowing. And in markets built on perfection, slowing is enough. Apple sells fewer iPhones today than it did years ago. Microsoft's cloud growth decelerates quarter by quarter. Nvidia's explosive expansion is already cooling as competition and regulation tighten. Tesla's margins compress as growth fades. Amazon's cloud dominance matures. Meta fights saturation. Alphabet faces limits once thought impossible. These are not headlines of failure. They are signs of maturity. And maturity is lethal to extreme valuations. The danger does not lie in earnings collapsing. It lies in expectations adjusting. Because when valuation multiples compress, when optimism fades into realism, the losses are not gradual. They are sudden, mechanical, ruthless. This is where the modern market reveals its hidden architecture. Over the last decade, investing has changed quietly but profoundly. Trillions of dollars no longer choose stocks based on judgment, valuation, or analysis. Instead, they follow formulas. Index funds, exchange-traded funds, passive vehicles that buy companies simply because they are large, and buy more of them as they grow larger. It feels safe. It feels diversified. It feels automatic. But it is neither neutral nor harmless. When money flows into these funds, it flows disproportionately into the biggest names. When money flows out, those same companies must be sold, regardless of price. This creates a feedback loop that amplifies both booms and busts. On the way up, it rewards concentration. On the way down, it enforces liquidation. And when 7 stocks represent nearly 1/3 of the market, that loop becomes systemic. This is not a theory. It is a structure. History has seen this movie before. In the early 1970s, investors believed they had discovered a group of companies so dominant, so well managed, so essential that valuation no longer mattered. They were called the Nifty 50. Household names, blue chip icons, stocks you could supposedly buy at any price and hold forever. They traded at extreme multiples. They dominated the market. They felt untouchable. Then inflation rose. Growth slowed. Interest rates climbed. And the illusion collapsed. Those companies survived. Their stock prices did not. Some fell 70%, others 90%. Investors waited decades to recover, if they ever did. The lesson was clear, brutal, and soon forgotten. Great businesses do not protect investors from overpaying. Today, the names are different. The technology is more advanced. The confidence is stronger. But the structure, the concentration, the valuation, the narrative of inevitability is hauntingly familiar. This documentary is not a prediction of panic. It is an examination of math. What happens when growth slows, but prices still assume acceleration? What happens when trillions are forced to sell the same stocks at the same time? What happens when passive systems meet active fear? The answer is not a crash caused by emotion. It is an implosion driven by structure, a slow tightening, a sudden release, and trillions in market value that vanish, not because companies failed, but because expectations finally met reality. As the lights dim on Wall Street and the final trades settle, the market looks calm, confident, certain. But history whispers a warning. The most dangerous moments are not when everyone is afraid. They are when everyone is convinced that nothing can go wrong. And tonight, the Magnificent Seven stand at the center of that belief. The rise of the Magnificent Seven. To understand how the modern market became so fragile, we must begin with how it became so powerful. Between 2010 and 2020, the U.S. equity market entered one of the most extraordinary expansions in financial history. Interest rates hovered near zero. Central banks flooded the system with liquidity. Capital became cheap, abundant, and impatient. In that environment, scale became everything. A small group of technology companies discovered something unprecedented. They could grow faster and become more dominant at the same time. Network effects, global platforms, cloud infrastructure, and data advantages allowed them to expand without the traditional constraints of geography, labor, or physical capital. Apple turned a phone into an ecosystem. Microsoft reinvented itself as a cloud utility. Amazon became the backbone of digital commerce. Alphabet monetized attention at planetary scale. Meta controlled social interaction. Nvidia became the brain supplier of artificial intelligence. Tesla rebranded manufacturing as software. As profits surged, investors rewarded them not just with higher prices, but with higher multiples. The market was no longer pricing what these companies earned. It was pricing what they might become. By 2023, these 7 companies were no longer just leaders. They were the market. Together, they accounted for more than 90% of the S&P 500's gains. Hundreds of other companies stagnated or declined, but index investors barely noticed. As long as the giants rose, the averages looked healthy. This was the first illusion. Valuation expansion, when price detaches from growth. Historically, even the greatest companies traded within limits. Market leaders IBM in the 1960s, Coca-Cola in the 1980s, General Electric in the 1990s, rarely sustained price-to-earnings ratios above the low 20s for long periods. Growth eventually slowed. Competition emerged. Markets matured. But in the 2010s and early 2020s, something changed. Valuations expanded despite scale. By 2025, the Magnificent Seven traded at an average P/E ratio of approximately 42. Some far higher. Tesla near 70. Nvidia briefly higher still. To justify these prices mathematically, earnings must grow at roughly 25% per year for 5 consecutive years, a pace historically achieved only by young, rapidly expanding companies, not trillion-dollar incumbents. This was the second illusion. The belief was that technology had broken the old rules, that artificial intelligence, cloud computing, and platforms had removed growth ceilings. But valuation is not belief. It is arithmetic. And arithmetic does not negotiate. Growth deceleration. The numbers begin to speak. By 2024, the data began to contradict the narrative. Apple's iPhone unit sales peaked years earlier. Global smartphone markets saturated. In China, once a growth engine, revenues declined as domestic competitors regained ground. Microsoft's Azure cloud platform told a quieter story. Growth slowed from nearly 50% in the early pandemic years to the high 20s, then into the mid-teens. Total company revenue growth hovered around 15%. If artificial intelligence were already a revenue explosion, the acceleration would be visible. Instead, costs rose faster than profits. Nvidia's revenue growth after a historic surge decelerated sharply, from triple digits to double digits, then toward normalization. At the same time, U.S. export restrictions permanently removed a significant portion of global demand, while competitors raced to develop alternatives. Tesla's numbers were even starker. Vehicle delivery growth fell from nearly 90% to single digits. Automotive gross margins collapsed from above 30% to the high teens. Yet the stock traded at multiples that assumed exponential expansion. Amazon's AWS, the profit engine, slowed into low teens growth as enterprise cloud spending matured. Meta faced advertising saturation. Alphabet confronted regulatory pressure and slowing search growth. None of this meant collapse. It meant maturity. And markets priced maturity very differently than momentum. Multiple compression. How value is destroyed without a crisis. Here is the most misunderstood concept in investing. Stocks can fall dramatically even when companies remain profitable. When growth slows, valuation multiples compress. A stock trading at 42 times earnings does not need earnings to fall to lose value. It only needs investors to accept paying 28 times earnings instead. That shift alone, still generous by historical standards, would erase nearly $5 trillion from the Magnificent Seven. If multiples revert further toward long-term averages, losses deepen rapidly. This is not panic selling. It is repricing. And repricing is merciless. Passive investing, the engine behind the feedback loop. The modern market is no longer driven primarily by human decision-making. Over $11 trillion now sits in passive index funds and ETFs tracking benchmarks like the S&P 500. These funds do not analyze fundamentals. They do not judge valuation. They allocate capital strictly based on market capitalization. If Apple represents 8% of the index, then 8 cents of every dollar flows into Apple automatically. As prices rise, weights increase. As weights increase, flows intensify. As flows intensify, prices rise further. This is how concentration becomes self-reinforcing. But the same mechanism works in reverse. When investors redeem shares from index funds, the funds must sell holdings proportionally. That means 32% of every dollar withdrawn requires selling the Magnificent Seven. As prices fall, market caps shrink. As market caps shrink, index weights decline. As weights decline, future inflows weaken. This is not psychology. It is plumbing. And plumbing does not care about narratives. Forced selling and the cascade effect. When declines begin, something critical happens. Margin calls trigger selling. Risk models reduce exposure. Volatility spikes. Redemptions accelerate. Index funds must sell into falling markets. Active managers, underperforming benchmarks, are forced to de-risk. Liquidity evaporates precisely where it is needed most. Because the Magnificent Seven are so large, they become the primary source of liquidity. They are sold not because they are worst, but because they are big enough to sell. This is how leaders become victims. As these stocks fall, the broader index declines. Retirement accounts shrink. Confidence erodes. More redemptions follow. The feedback loop tightens. Historical parallel. The Nifty 50 collapse. This is not unprecedented. In the early 1970s, the Nifty 50 dominated the U.S. market. They were considered one-decision stocks. Buy them. Hold them. Never sell. They traded at average P/E ratios near 42, almost identical to today. When inflation surged, interest rates rose, and growth slowed. Valuations collapsed. Some stocks fell over 90%. Even the best companies lost more than half their value. Coca-Cola did not break even for shareholders for 15 years. The lesson was not that the companies were bad. It was that prices were wrong. Why this time feels different and isn't. Today's investors argue that technology, scale, and data make these companies immune. But every era believes its leaders are different. Railroads, radio, television, conglomerates, the internet. The pattern never changes. Growth slows. Valuations compress. Capital concentrates losses where confidence once lived. The inevitable math. If the Magnificent Seven lose $7 trillion in market value, not through collapse, but through normalization, the impact will not be contained. They are the index. They are retirement portfolios. They are passive flows. When they fall, everything feels it. This is not a forecast to fear. It is a description of structure. And structures, once built, do not ask permission before they unwind. By the time the dust settles, the story of the Magnificent Seven will not be told as a tale of corporate failure. Apple will still sell hundreds of millions of devices. Microsoft will still run the digital infrastructure of the modern world. Alphabet will still shape how information flows. Amazon will still power global commerce. Nvidia will still design the engines of artificial intelligence. Meta will still influence culture. Tesla will still build electric vehicles. The companies will survive. That is what makes this episode so difficult for investors to accept. Because survival is not the same as safety. What this documentary has revealed is not a scandal, a conspiracy, or a sudden collapse driven by panic. It is something far less dramatic and far more dangerous. A slow, mechanical unwind built into the structure of the modern market itself. The concentration was never hidden. The valuations were never secret. The growth deceleration was reported quarter after quarter. And yet the system kept rewarding size, not sustainability. At the heart of implosion lies a simple mismatch. Expectations built for a world of infinite acceleration colliding with the reality of maturity. When companies grow from millions to billions, and from billions to trillions, the laws of scale assert themselves. Markets saturate. Competition intensifies. Margins compress. Growth slows. That transition is natural. But when prices are still anchored to the fantasy of perpetual expansion, the adjustment is not gentle. It is violent. Not because earnings vanish, but because multiples do. This is the lesson history repeats most often, and investors relearn most painfully. Valuation is destiny over long enough time frames. You can own the best businesses in the world and still suffer catastrophic losses if you overpay for certainty that never existed. The modern investor was told this time was different. Told that passive investing had removed risk. Told that diversification meant safety. Told that owning the index meant owning the future. But the index itself had changed. It quietly transformed from a broad representation of the economy into a narrow wager on a handful of companies. What appeared diversified on paper became concentrated in practice. Risk did not disappear, it simply hid inside scale. When flows were positive, the system felt brilliant, efficient, automatic, self-reinforcing. But systems optimized for upward momentum behave very differently when momentum fades. When redemptions begin, there is no discretion, no judgment, no patience. There is only proportional selling. And when nearly 1/3 of the market sits in 7 names, those names become the shock absorbers for the entire system. This is how leadership turns into liability. The historical parallel is uncomfortable because it is so precise. The Nifty 50 were once described in the same language. Invincible, essential, untouchable. Investors were not wrong about their importance. They were wrong about their price. Coca-Cola did not fail. IBM did not disappear. Disney did not die. But shareholders waited decades to recover if they ever did. Today's market stands at a similar inflection point. Not because history must repeat exactly, but because human behavior and financial structures rarely evolve as quickly as technology does. The Magnificent Seven did not create this risk alone. It was built by incentives that rewarded scale, policies that suppressed volatility, and systems that replaced judgment with automation. Each step made sense in isolation. Together, They created fragility, and fragility only reveals itself under stress. The evaporation of $7 trillion in market value, if it comes, will not arrive with sirens or headlines at first. It will arrive quietly through rebalancing, repricing, and the steady erosion of assumptions investors believed were permanent. Retirement accounts will shrink. Confidence will fade. The question will not be how did this happen, because the evidence was always there. The real question will be why so many believe concentration was the same thing as safety. Markets do not punish innovation. They do not punish success. They punish certainty. And the greatest certainty of all is the belief that this time is different. As the cycle turns, the Magnificent Seven will remain magnificent in influence, in revenue, and in technological reach. But their stock prices, once elevated by belief, will return to something far less forgiving: mathematics. History does not need villains. It only needs repetition. And for investors willing to look past the noise, the lesson is as old as markets themselves. The greatest risks are not the ones everyone fears. They are the ones everyone assumes no longer exist. If you want to understand what comes next, what this means for markets, portfolios, and the future of investing, stay with us. Because the implosion is not the end of the story. It is the consequence of ignoring how every great market cycle truly ends.